Hello everyone and welcome to another one of my investing videos where I try to simplify aspects of the markets and how they work. I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Okay, options. In this video, I will try to explain the basics of what they are and how they are used. An option is a contract that gives someone the right or obligation to buy or sell the underlying asset. Okay, so with stocks, one contract is normally equivalent to giving someone the right or obligation to buy or sell 100 shares of a particular company at an agreed upon price, referred to as the strike price, on or before a specific date, also known as the expiration date. For example, suppose you buy a contract with a $15 strike price that expires on July 4th. Well, now you have agreed to buy or sell 100 shares at $15 per share on or before July 4th. So why trade options? Well, some do it to generate extra income, and others do it to try and protect their accounts from market volatility. Suppose you own stock in a particular company that has news coming out in the future, so you decide to purchase an option to try and protect yourself from any possible downside move. Or someone believes a company is going to make a big move to the upside soon, so they buy an option in order to profit from the potential run-up in price. What are some key terms to know? Bullish means you believe the price is going to go up, and bearish means you believe the price is going to go down. Long is when you buy a contract, short is when you sell a contract. There are two types of option contracts, call and put. A call will give someone the right to buy or the obligation to sell shares. Suppose shares are trading at $10 and you decide to buy a call at the $11 strike price. If the share price is below $11, the option is said to be out of the money. If price reaches $11 exactly, it's said to be at the money. And if price stays above $11, it is said to be in the money. A put will give someone the right to sell or the obligation to buy shares. Suppose the share price is trading at $15 and you decide to buy a put at the $10 strike price. If the share price is above $10, the option is said to be out of the money. If the price reaches $10 exactly, it is said to be at the money. And if price stays below $10, it is said to be in the money. Okay, so how do these terms work with one another? What if you are long or short or bullish or bearish? Well, depending on the combination, there's an option for you. If you are bullish and want to be long, you can buy a call. And if you want to be short, you can sell a put. If you are bearish and want to be long, you can buy a put. Or if you want to be short, you can sell a call. Okay, how are options priced? Options are based on a series of complex math equations, but luckily very smart people have simplified them for everyday use, so I don't have to bore you with all that extra math. An option price can be divided into two sections, intrinsic value and extrinsic value. Intrinsic value comes from the option strike price and the underlying share price. Extrinsic value is based on time till expiration and implied volatility. Interest rates can affect both the intrinsic and extrinsic value of an option. It's important to remember when I mentioned earlier that a contract represents 100 shares. Well, an option is priced with that in mind. Options have what's called an option multiplier, and it is the option contract price multiplied by 100. For example, suppose an option costs 10 cents. Applying the option multiplier to the price of the option contract makes the total cost of the option equal to $10. Intrinsic value is only present if the option is in the money. The calculation is slightly different for call and put options. For example, if you buy a call option with the $10 strike price, but the shares are currently trading at $10.52, you simply subtract the share price from the strike price to determine the intrinsic value of the option contract. Don't forget the option multiplier. Now, if you buy a call option with the strike price of $10, but the share price is trading at $9.50, because the share price is below the strike price, it is said to be out of the money and it contains no intrinsic value. If you buy a put option with a $10 strike price and the stock is currently trading at $9.20, for the put it is said to be in the money and you simply subtract the strike price from the share price to determine the intrinsic value of that option contract. Again, don't forget the option multiplier. If you buy a put option with a strike price of $9, but the share price is trading at $9.50, because the share price is above the strike price, it is said to be out of the money and it contains no intrinsic value. Extrinsic value is also known as time value or the premium of a contract. It is the cost a buyer must pay in order for the seller of a contract to take on the risk of selling that contract. Extrinsic value will vary based on how much time an option has until expiration. It is normally determined by subtracting the option contract price from the intrinsic value of that option contract. For example, if you buy a call option with a strike price of $10 and the share price is currently at $9.50, and this contract has 1 month until it expires and it costs 30 cents. Because the option is out of the money, it has no intrinsic value. That means the full value of the contract is made up of extrinsic value. Now let's suppose you buy a call option with a strike price of $10 and the share price is at $10.20. This contract expires in 1 month and it costs 30 cents. Because the contract is in the money, it contains 20 cents of intrinsic value. This leaves us with 10 cents of extrinsic value. Let's explore several ways buyers and sellers can be affected when buying or selling a call option. Suppose a company's share price is trading between $9 and $11, and a person decides to buy a call option with a $12 strike price that expires in May. This option is currently out of the money and has no intrinsic value and a premium of 10 cents made purely out of time value. Now, the stock will continue to trade until expiration, but there are 3 possible outcomes and 4 scenarios that can occur. The possible outcomes are that it expires in the money, at the money, or out of the money. In scenario 1, the share price is at $13 at expiration. The buyer paid 10 cents for the contract and the seller collected 10 cents. It is in the money and has gained $1 of intrinsic value. The buyer holds the contract, so the buyer benefits from the gain in the intrinsic value. The buyer can sell the contract for a total gain of 90 cents, and the seller will only have made 10 cents on this transaction. However, because the option is in the money, the buyer has the right to exercise the contract and buy 100 shares of the underlying at $12 per share from the seller, leaving the seller with only a gain of 10 cents minus 100 shares. In scenario 2, the share price is at $12 at expiration. The buyer paid 10 cents for the contract and the seller collected 10 cents. It is in the money but has $0 of intrinsic value. The buyer will have lost 10 cents and the seller will have made 10 cents from this scenario. However, because the option is in the money, the buyer has the option to exercise the contract and collect 100 shares from the seller, leaving the seller with a gain of 10 cents minus 100 shares of the underlying. In scenario 3, the share price is at $11 at expiration. The buyer paid 10 cents for the contract and the seller collected 10 cents for selling the contract. It is out of the money and has no intrinsic value. The buyer has a total loss of 10 cents and the seller will have made 10 cents from this scenario. Again, don't forget about the option multiplier. Some of you are probably looking at this and saying, didn't he say 4 scenarios? And you're right. And it is the most overlooked scenario by most option buyers and sellers. This is the break-even scenario. This occurs when the intrinsic value is equal to the extrinsic value. In this scenario, let's say that the share price is at $12.10 at expiration. The buyer paid 10 cents for the contract and the seller collected 10 cents for selling the contract. It is in the money and has gained 10 cents of intrinsic value. The buyer can sell the contract for 10 cents, essentially breaking even, and the seller again will only have made 10 cents from this transaction. However, because the option is in the money, the buyer has the right to exercise the contract and buy 100 shares of the underlying at $12 per share from the seller, leaving the seller with only a gain of 10 cents minus 100 shares. Put options work in the same way as call options. However, with puts, the buyer has the right to sell the shares or the obligation to buy them. Let's explore several ways buyers and sellers can be affected when buying or selling a put option. Let's suppose a company's share price is trading between $11 and $13, and a person decides to buy an option with a $10 strike price that expires in May. This option is currently out of the money, has no intrinsic value, and the premium of 10 cents is made purely of time value. Now the shares will continue to trade and you'll have the exact same scenario as the previous example where the stock will be either in the money, at the money, or out of the money. In scenario 1, the share price is at $9 at expiration. The buyer paid 10 cents for the contract and the seller collected 10 cents for the contract. It is in the money and has gained $1 of intrinsic value. Again, the seller does not gain any intrinsic value for selling the contract. The buyer can sell the contract for a gain of 90 cents, and the seller will only have made 10 cents out of this transaction. However, because the option is in the money, the buyer has the right to exercise the contract and sell 100 shares of the underlying stock at $10 per share to the seller, leaving the seller with only a gain of 10 cents plus 100 shares that he purchased at $10 per share. In scenario 2, the share price is at $10 at expiration. The buyer paid 10 cents for the contract and the seller collected 10 cents for selling the contract. It is in the money but has $0 of intrinsic value. The buyer is left with a loss of 10 cents and the seller will have gained 10 cents. However, because the option is technically in the money, the buyer has the right to exercise the contract and sell 100 shares of the underlying to the seller, leaving the seller with only a gain of 10 cents plus the purchase of 100 shares. In scenario 3, the share price is at $11.50 at expiration. The buyer paid 10 cents for the contract and the seller collected 10 cents for selling the contract. It is out of the money and has no intrinsic value. The buyer has a total loss of 10 cents and the seller will have made 10 cents from this transaction. The break-even is similar to the way it was calculated for the call option. And let's not forget about the option multiplier. Let's suppose you are looking at a call and put option chain and your current share price is at $10. If you buy a call with the share price at $10, you are at the money. And if you buy a call with a strike price that has a value lower than the share price, your contract is in the money and its intrinsic value is the difference between the strike price and the share price. If you buy a call with a strike price above the share price, you are out of the money. If you buy a put with a strike price at $10, you're at the money. And if you buy a put with a strike price that is higher than the share price, you are in the money. And its intrinsic value is the difference between the share price and the strike price. If you buy a put with a strike price below the share price, you are out of the money. And the extrinsic value is determined by the time left till expiration. Okay, so now we know how they are priced based on time till expiration and the interaction between share price and strike price. But we still don't know how implied volatility and interest rates affect the price, and there's still another aspect of time that affects the price of an option contract. Most importantly, what are the risks associated with option contracts? Well, for that, we have what are known as the Greeks. Simply put, the Greeks describe the risk associated with an option contract. They are determined by evaluating the volatility of an underlying share price and coming up with the potential future price range for that share price, and by analyzing the effects of time decay and the changes to the risk-free rates. Delta is among the most popular Greeks. It gives us an idea of how much an option contract will go up or down if the underlying share price moved by $1. It is commonly referred to as the percent an option contract has of being in the money. For example, a delta of 10 cents has a 10% chance of being in the money, and a delta of 50 cents has a 50% chance of being in the money. It's also important to note that a call delta will range between 0 and 1, and a put delta will range between 0 and -1. The value of negative and positive will also depend on whether you are long or short a put or a call. Direction of share price will determine whether to add or subtract the delta from the option contract, and in turn the effect on the option contract. For example, if the price goes up and the contract is long, the call option price will go up and the put option price will go down. If price goes down, the opposite will happen. Okay, example time. Suppose you have a company with a share price that is trading around $9 and you find an option contract that has a strike price at $9, a contract price of 50 cents, and a call delta of 10 cents and a put delta of -10 cents. Now let's suppose that share price has risen to $10. Well, because the price went up by $1, we know that the option contract will be affected by the value of delta. In this case, because the price went up, we will add the deltas to the option contract. We will add the call delta of 10 cents to the call option, and we will add the put delta of negative 10 cents to the put option. So the new value of the call option after the effects of delta is 60 cents and the put option is 40 cents. Let's suppose the share price decreased by $1 instead. Well, in this case, because the price went down, we will subtract the delta values from the contracts. We subtract 10 cents from the call contract, and we subtract negative 10 cents from the put option, leaving the new value of the option contracts at 40 cents for the call option and 60 cents for the put option. You might be wondering, what happens if the price moves up by more than $1? Well, this is where our good friend gamma comes into play. Gamma measures the change in delta for every $1 change in the underlying share price. Gamma will be positive if you are long and negative if you are short. This does not mean addition or subtraction as we think, because gamma determines the rate of change in delta, and that is determined by an increase or decrease of the share price relative to your position. Again, remember that for a long contract, delta is positive on calls and negative on puts. And as we just learned, gamma is positive on long contracts. So how will this affect our contract price? Well, let's suppose a call option has a delta of 10 cents and a put option has a delta of negative 10 cents. These options both have a gamma of 2 cents. If price goes up by $1, the delta for the call option will increase by 2 cents, and the delta of the put option will also increase by 2 cents. It's important to note that the closer the option contract gets to being at the money, the larger the value of gamma becomes. Okay, suppose you have a company with a share price that is trading around $9, and you find an option contract that has a strike price at $9, a contract price of 50 cents, has a call delta of 10 cents, a put delta of negative 10 cents, and a gamma of 3 cents. Now let's suppose the share price goes up by $2. Well, we know that the option contract will be affected by the value of delta for each dollar it goes up, and delta will be affected by gamma for each dollar the price went up. Let's see how this affects the option contract. We know the price went up by $2 and the contract is 50 cents for the call and for the put. For the first dollar the price rose, the call option will add 10 cents and the put option will add negative 10 cents. For the second dollar that went up, the delta for the call option will increase by gamma, which is 3 cents for a total of 13 cents, and the put option will also increase by 3 cents for a total of negative 7 cents. Adding these values up, we now have a call option that has gone up by 23 cents and a put option that has gone down by 17 cents due to the effects of delta and gamma. What if the share price went down $2? How will this affect the contract price? In this case, we know that the price went down by $2 and that the contract price is 50 cents for the call and for the put. For the first dollar that the price dropped, the call option subtracts 10 cents and the put option will subtract negative 10 cents. For the second dollar that went up, the delta for the call option will increase by gamma, which is 3 cents, for a total of negative 7 cents, and the put delta will also increase by 3 cents for a total of 13 cents. And now we have a call option that has gone down by 17 cents and a put option that has gone up by 23 cents, based on the effects of delta and gamma. We now reach what is considered by many to be the most popular Greek. Many strategies are based on and built around theta. Theta measures how time affects an option price. It is commonly seen as a change over a 24-hour period, but as you get closer to expiration, it can affect an option price intraday. The price of an option is constantly decreasing. This is known as time decay. The value of theta assumes that the price of the underlying share does not change. Theta will increase as you get closer to being at the money. Again, the more time your option has till the expiration, the slower the rate of time decay will be. It is believed to begin increasing at a significant faster rate when you're about 45 days or less till expiration. Okay, suppose you have a company whose share price is trading at $9 and you find a call or put option that costs 50 cents and has a theta of negative 10 cents. Now 24 hours have passed. We know that 1 day has passed and theta will affect the option price, and we know that the contract cost is 50 cents. Theta will reduce the call option by 10 cents and it will also reduce the put option by 10 cents. Remember, theta is an effect that measures time decay, so it will always be subtracted from the contract price, regardless of the direction of the share price. So this means both our call and put options have decreased by 10 cents and are now worth 40 cents. Vega is an important Greek. It is used to determine the change in price of an option for every 1% change in implied volatility. Remember that volatility represents the fluctuations of the current share price movement, and implied volatility is the market predicted future price movement. It is affected by the supply and demand of options. For example, if demand for a call option increases, the IV for that call option will also increase. Vega can move in response to sudden share price also. This means that Vega can be impacted by option demand and price fluctuations in the share price. In this example, we have a contract price of 50 cents, a Vega of 10 cents, and implied volatility goes up by 3%. In this case, Vega will be multiplied by the change in IV. We know that the change in IV is up 3%, the contract price is 50 cents, and the calculated Vega is 30 cents. This will be added to the contract price to get a final call or put price of 80 cents due to the effects of Vega. Let's suppose that IV went down by 3%. In this case, Vega is calculated the same way as before, and we get a Vega of 30 cents. But now, because the IV went down, we subtract Vega from the value of the call and the put, giving us a final contract value of 20 cents for the call or the put due to the effects of Vega. Rho is the least looked at Greek, and that is mostly due to the little impact that has in an option price. It measures the change in an option price due to the change in a risk-free interest rate. Positive and negative rho will depend on whether you are going long or short and if you have a call or a put. In this example, we have a contract price of 50 cents, a rho of 1 cent, and a put rho of negative 1 cent. And the interest rate goes up by 2%. Rho will be multiplied by the amount of change in the rates, giving us a rho of 2 cents for the call and a negative 2 cents for the put. Now let's see how this impacts the option contract. We know that the change in rate is up 2%, the contract price is 50 cents, and the calculated rho is positive 2 cents for the call and negative 2 cents for the put. This will be added to the contract price to get a final call price of 52 cents and a final put price of 48 cents. Let's suppose the rates went down by 2%. In this case, rho is calculated the same way as before, but now because the rates went down, we subtract the rho value from the call and put contracts, giving us a final contract value of 48 cents for the call and 52 cents for the put contract due to the effects of Vega. Now we get to tie all that we learned into an example. Suppose you have a company with a share price that's trading around $9 and you find an option contract at the $9 strike price that expires in 2 days with a contract price of 50 cents, a call delta of 10 cents, and a put delta of negative 10 cents, a gamma of 5 cents, a theta of negative 13 cents, a Vega of 2 cents, and a call rho of 2 cents, and a put rho of negative 2 cents. Because the contract is at the money, it has no intrinsic value, meaning the contract price is made up purely out of extrinsic value. Now let's suppose that the share price goes up by $2 in 1 day. The implied volatility increases by 10%, and the interest rates rise by 1%. So what do we know? We know that the option contract costs 50 cents, and for the first dollar, the price rose, the call option will add 10 cents. For the second dollar, gamma will increase delta by 5 cents for a total delta of 15 cents that will be added. We know that 24 hours went by, so theta will decrease the contract by 13 cents. IV rose by 10%, so that results in a Vega of 20 cents. And because interest rates rose by 1%, rho will have a value of 2 cents. Now that the price has risen by $2, we know that the contract is in the money and has gained intrinsic value. When we add all these values for the call option, the new cost of the contract will be $2.84. How did the put option do? We know that the contract price is 50 cents. And for the first dollar, the price rose, the put option will add negative 10 cents. For the second dollar, gamma will increase delta by 5 cents for a total delta of negative 5 cents. Again, 24 hours went by, so theta will decrease the contract by 13 cents. IV rose by 10%, that will result in a Vega of 20 cents. And because interest rates rose by 1%, rho will have a value of negative 2 cents. The put contract happens to be out of the money in this scenario, so it does not get any intrinsic value. When we add all these values for the put option, the new cost of the contract will be 40 cents. Here you can see that the Greeks really do have an impact in the overall price of an option contract. The call option gained a significant amount of value, and thanks to the IV spike, the put managed to retain a good portion of value as well. In this final example, we will see the impact of the contracts if the price went down by $2. We have the same parameters as the previous example, except the price will go down by $2 in 1 day. So how does this affect the price of the options? On the call, the contract costs 50 cents. And for the first dollar, the price drop, the call option will subtract 10 cents. For the second dollar, gamma will increase delta by 5 cents for a total delta of negative 5 cents. We know that 24 hours went by, so theta will decrease the contract by 13 cents. IV rose by 10%, that will result in a Vega of 20 cents. Interest rates rose by 1%, the call roll will have a value of 2 cents, and that will be subtracted from the contract. The call contract is out of the money and therefore has no intrinsic value. Adding all these up gives us a call contract of 40 cents. For the put, the contract costs 50 cents. For the first dollar that the price dropped, the put option will subtract negative 10 cents. For the second dollar, gamma will increase by 5 cents for a total delta of 15 cents. Theta will decrease the contract by 13 cents because 1 day passed. IV rose by 10%, resulting in a Vega of 20%. The interest rates rose by 1%. Rho will have a value of negative 2 cents, and that will be subtracted from the option price. The put contract happens to be in the money and has $2 of intrinsic value. We add up all these values up and end up with a put contract value of $2.84. It is important to note that most of my examples are based on pure price changes to the contract, not accounting for any actual purchase of the contract. For example, if you would have bought the call or put contract in the previous example, the contract price would have to account for the 50 cents to purchase the contract. The value of the contracts would be adjusted for the money spent. Adding the option multiplier, here you can see that if you try to close the call contract, you would have a net loss of $10. And if you tried to close the put contract, you would have a net gain of $184. If you found this information helpful and would like to see more videos like this or get notified when I release new videos, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see a video on a specific topic. Thank you for watching and have a great trading week.